Welcome back. One of the most important questions any investor asks before committing capital to a fund is, what does the exit look like? Not in a theoretical sense, in a real sense. Who are the buyers? What have they paid for comparable assets? And what's a realistic expectation for the multiple on invested capital? Today, I want to address those questions directly. Let's start with who's buying. The FBO and aviation infrastructure space has a well-documented and active buyer universe. At the top, you have the large national FBO networks, Signature Aviation, Atlantic Aviation, that are always evaluating acquisition opportunities to extend their geographic coverage. Below them, you have the private equity-backed platforms that are actively building, Apollo's Modern Aviation, Bain Capital's App Jet Center, and several others. And beyond those, you have the infrastructure fund tier, global infrastructure partners, Brookfield, and similar managers who have built significant infrastructure portfolios that are increasingly looking at aviation as an asset class worth owning. So what are these buyers paying? Let me give you some texture on the deal economics. The transactions haven't all been publicly disclosed at the individual asset level, but the overall picture from available data is that FBO platforms, particularly those in supply-constrained markets with strong cash flow profiles, have been trading at multiples that reflect the infrastructure character of the asset rather than the operating company character. Strategic acquirers are paying for the long-term ground lease positions, the captive customer relationships, and the competitive moat created by the airport location. Those are infrastructure-like attributes that command infrastructure-like multiples. The Bain and Apollo transactions were not cheap by any conventional metric, which tells you a lot about how sophisticated capital is pricing these assets today. And there are multiple exit pathways available here. It's not just a whole platform sale. The most straightforward is a whole platform sale to a strategic acquirer or larger infrastructure fund, one transaction that provides full liquidity to all LPs simultaneously. But you could also structure an asset-by-asset disposition over the back half of the fund life, selling individual airport positions to different buyers at different points as they mature and as market conditions are favorable. Or you could pursue a recapitalization, bringing in a larger infrastructure fund as a senior capital partner at a valuation that provides partial liquidity to early LPs while continuing to operate and grow the platform. All three of these pathways have been executed in comparable transactions in the FBO sector. Now, what's the realistic return expectation? Without getting into specific projections that would constitute forward-looking investment advice, which we're not offering in this podcast, what I can say is that the combination of a current yield from base rents, annual rent growth running well above inflation, MRO and FBO recurring revenue, and a platform premium at exit creates a return profile that our modeling suggests is competitive with the best risk-adjusted alternatives available to institutional capital today. The yield component means you're not entirely dependent on the exit for your return, which reduces the binary risk that pure appreciation strategies carry. And the exit premium means the capital appreciation component can be significant when it comes. That's the exit thesis in plain language. Known buyers, active market, multiple pathways, and a well-supported return structure that doesn't require everything going perfectly to deliver compelling results. That's a fund worth taking seriously.